Welcome back to the Chain Reaction Podcast. I'm your host, Tom Shaughnessy. I'm also a co-founder at Delphi Digital, where we're 5 full-time analysts focused on institutional crypto research. If you aren't a subscriber or you haven't seen the site, you're missing out. So visit the site while you're listening to this episode. One quick housekeeping item. This podcast is strictly informational and educational and is not investment advice or solicitation to buy or sell any tokens or securities or to make any financial decisions. I may personally own tokens mentioned on the podcast. With that out of the way, today I'm thrilled to have on Andrew Keys and James Slazas of Dharma Capital. This episode was recorded the day of Andrew's announcement that he was joining Dharma after an impactful career at ConsenSys. For those who've been listening to the podcast for a while, Andrew was one of our first guests on the podcast. Dharma's flagship fund is a $100 million Ether-optimized long strategy with $100 million under management, which is sizable for the space. On this episode, we go into the strategy, both James and Andrew's careers, their results, goals, and so much more. The brainpower between James and Andrew is remarkable. With that, let's jump into the episode. Hey everyone, welcome back. Today I'm thrilled to have Andrew Keys and James Slazas from Dharma Capital. How's it going, guys?
Going well. Thanks for having us.
Yeah, it's a pleasure to have you guys on. So why don't we jump in with you, James? Tell us a bit about your background and how you founded Dharma.
I got involved into the derivative markets way back in 1985. And so been focused on basically trading different types of derivatives. I ran a derivative arbitrage book at Lehman. And
was it your fault?
Not my fault, yes. And then probably 2013, 14, started to look a little bit at Bitcoin. And then my good friend next to me, went to the first meetup for Ethereum and started to look at what is the smart contract space. And so I subsequently met with Vitalik, with Joe Lubin, and was asked to head up capital markets for ConsenSys. And that really became a big opener to all different types of financial products. And all the different institutions have been starting to look at the space or learn how to spell blockchain. And so as we went through that, they kept growing up a little bit and a little bit. The part that was missing, obviously, is what institutional infrastructure is actually needed. So we had all this fantastic decentralized ideas and thoughts. Let's have a decentralized exchange, derivative products, things of that nature. But if you're a regulated institution, you can't trade that. You have a lot of AML, KYC type of issues that you have to deal with. And so that's really where I focused on. I looked at it as, I'm not going to be writing code, so instead I'm going to bring in my derivative expertise and my just financial macro view and put in place those different parts that are needed. So to found Dharma, I left ConsenSys in last year, 2018, and Dharma is a registered CFTC fund. It's a commodity pool operator, commodity trading advisor. All of our service providers are all the very traditional institutional players. It's Opus Fund Services, Duff & Phelps, Walker's Global, KPMG for audit. And all of these type of groups are more of so that institutions can have that comfort that there's an institutional investment vehicle for them to gain exposure into this space. And so Dharma, with that in place, has lots of different policies, procedures so that we can manage the assets professionally. And we contribute to the marketplace as much as we can for building out more and more institutional infrastructure. So extra guidance within different bulge bracket firms for how to custody or how to provide custodial service to other different funds. We also are involved in a project called True Digital Holdings, which has a reference rate for Ether and Bitcoin. These are reference rates that aren't off of exchanges, but off of market dealers. So similar to how LIBOR is created. These type of products are all things that are needed so that as an asset, not the technology, but as an asset for it to grow up and to be able to be an institutional product.
It's awesome. Congrats. And we're recording on the day of you guys announcing Andrew joining. So Andrew Keys is here as well. For reference, Andrew was one of our first podcast guests ever. Appreciate you coming on back then, Andrew.
Thanks for having me then.
Yeah, so tell us, Andrew, your role, how you got started at, or why you joined Dharma, and give a brief overview of your extensive career at ConsenSys.
So I was one of the first attendees at a poorly attended Ethereum meetup in 2014, where I met none other than Joseph Lubin and quickly fell down the rabbit hole, really understanding the world from a construct of intermediaries and counterparties. Once I learned that I was taking for granted how much intermediaries rent seek. And long story short, that turned into an odyssey around Earth with James and many others, basically explaining the art of the possible with respect to blockchain. And we started by creating simple financial instruments like derivatives and went on to build supply chains, went on to build the tokenization of fiat for central banks, went on to build for enterprises like Microsoft, JP Morgan, Santander, British Petroleum, Procter & Gamble, governments like the Monetary Authority of Singapore, the Emirate of Dubai, and that story will still go forever. And ConsenSys is in a perfect place to do so. That said, we wanted to start creating regulated products and financial services and actual asset management. It was best to have a compliant fund sit outside of ConsenSys. So ConsenSys is one of our first clients, and we will be using ConsenSys software when it makes sense to improve our processes. Tools like OpenLaw, which is basically digitized legal agreements. So with that said, we will be still working very closely, but we've created Dharma to really hone in on the institutional investor and creating alpha in this next generation asset class of digital commodities.
It's incredible that you guys are using what was created at ConsenSys, whereas a lot of investment funds basically take the other side and take investments and then use kind of what the products or services are built on. So just to give listeners an overview, has Dharma launched, and where do you guys fit on the stack compared to, VC funds from, all the way over from Pumps, Morgan Creek Digital, all the way up to Chris Bernitzky's at Placeholder? Where do you guys fit in on the investment stack per se?
So for us, we have a little bit different view on the marketplace, and essentially we're looking to provide a product so that an institution can have exposure to the blockchain, right? So if they believe in what the blockchain represents, they want to have an investment in this space. What we've done is we've created singular assets. We call them DOLs, so Dharma Optimized Long. Our first one that we had launched is the Dharma Optimized Long Ether Fund, and what that is to do is basically to say we're creating different core holdings for an institution that they have to have these invested in if they want to be long in the blockchain. What the hard part for us when we look at private equity investments is to say, how do you get paid for that? Right now, we have an issue within blockchain where we're still working on global scalability. So if we're trying to attain global scalability, which then can lead to adoption, which then can have many, many different types of applications, different types of decentralized dApps that can be provided. When we look at our private equity side of things, then you're having to basically invest in a team, what the team is actually wanting to execute upon, and then also the risk of that global scalability being reached. So, I really look at this more as, when we look at the protocol layers that we make our singular assets of, those are private equity investments where they have the same type of risk-reward ratio, but that there is liquidity and there is the ability to basically get validation. So we're able to see and track how are we attaining scalability or not, right? And so as that continues on and on, fantastic. We can verify to our investors, manage that risk. If we were to put the same investments just into a private equity investment, we don't have that flexibility, right? And so now we have to just say, well, we've made this investment. The team might be able to pivot to one chain versus another. But again, we're still forced to look at that global scalability as a large risk that we have to look at. So we don't, we really kind of, I would say, position ourselves as it's a private equity, except we have liquidity, right? So we're actively managing what we believe are fundamental core holdings in blockchain.
And to your prior question, have we launched? We did launch, and we launched actually in May of 17, but it was a family office strategy where James's brother, who's a quant, risk managed internal Ether. We've launched publicly to external investors as of January of this year.
So a lot of VC funds, I think, approach with stellar returns from a lot of great private investments, BlockFi, Coinbase, but they don't really talk about all of the horrible investments they've made, the long lockup periods, the fees, having to manage team risk and liquidity risk. You guys are going to an institution and saying, hey, Ether, Bitcoin is a fundamental investment. We're not going to compare the tech. We're just going to optimize the position for you. Is that correct?
Absolutely. Our goal is to create alpha of the protocols. So from 1996 to 2006, 85% of .coms went to zero. For every Google, there were 10,000 that were not Google. But what we believe is in this next generation Web3 via blockchain, there is a systemic protocol layer, and that's composed of storage of value, a smart contract layer, file storage, mesh networking, and messaging. And basically, we're doing fundamental research on the best in breed in those areas. And then once we make that fundamental research decision that they do qualify in terms of regulatory clarity and liquidity, then we essentially hand them to our quant that does an alpha overlay. So the notion is that if you had 100 Bitcoin and you gave them to me, my goal would be to give you back somewhere between 112 and 115 Bitcoin a year later, because you already are net long, and this is the alpha generation that improves over hodling it.
Makes a lot of sense. So $100 million Ether fund, and then you also have the other strategies as well. That's quite large for the space when I feel like funds are having trouble raising $5 or $10 million. Do you think that gives you an advantage when people and institutions start to look at Dharma potentially as, the next, say, Goldman or, the next major fund here?
So yes. And I think it's very interesting to map that question on top of the PwC blockchain report. I think it was 60 or 70% of the funds had less than $10 million AUM. 50% of them didn't have a fund administrator or a custodian. And the majority of the funds, the managers of the fund had less than 3 years of investment experience. So we try to contrast all of those facts.
So you guys have set up a great fund, which basically it seems like has all the best tax implications or tax savings based with all, hopefully the best custody solutions here. Where do you think you guys compare to other funds based on the infrastructure that you've built your fund on? Like, do you have better custodians? Do you have better tax implications? What are the building blocks that underpins Dharma?
My initial answer is we really don't look at it as having competitors, and we don't really care about if there is a competitor or not. We are providing an institutional grade product that is risk managed by very seasoned professionals. Our traders, we have all 30 plus years in the capital markets business. This isn't just, okay, I bought some digital asset really cheap and it just magically went up. Right? We know how to trade and manage risk. We also are very have the fundamentals within blockchain to the nth degree. And we've also been a part of that whole conversation globally, right? So I don't really look at it from that competitor side of it. What I would say is, yes, we have put in place the proper partners for service providers, right? We've also, it's not that we have better custodians, right? But that we make sure that who we're using, now different custodians have an insurance wrapper from Lloyd's of London, right? So until we have those larger, Bank of New York, State Street custodials, we at least want to have the credit protection for our investors as they give us their assets. But it's much more of having all the different parts of policies in place for tracking how do we manage the custody, how do we manage our trading, all the different parts that are involved with asset class.
It's incredible. So I see a lot of funds out there where they lead their emails with, the fund's up 50%, the fund's up 75%, but they rarely ever compare that to a benchmark or a framework. How do you guys think about benchmarking? How do you guys think about reporting returns? And if you can go into it, we can get into how you've done so far.
For us, it is all about benchmarking. As I was saying before, right now we're going through this global scalability, right? Will blockchain attain a certain level? So there's a 2, 3, 4 year time window for scalability to be reached. And if that's the case, then we're going to have a lot of volatility, and we're going to have a lot of different points that will reference, did we reach that? Did we attain it? Or did we have to push it? Did we fail? Things of that nature, right? So this time window is really more of an accumulation phase for anybody that's I would say, existing in the space. They understand where is the tech today, where it needs to get to so that we can, let's say, have the new internet. And so it really has to be more of not my dollar return on what is the market cap of Ether, of Bitcoin, or anything like that, but more of how many of those Ether, of those Bitcoin am I accumulating pre global scalability, and then adoption, and then the institutional money flows that can come in because it has been validated. So for us, we benchmarked ourselves to the TDH reference rate for Ether. And since May 2017, I believe we were up approximately 160% alpha to the benchmark. And so the way we look at that, obviously we're really happy with our returns. We have, it's not to say that that's my regulators make me say it's not that's a guarantee for future performance. But what we do is we look at this so that we can gauge what we're doing for our investors. And so we created something also that I just want to say is a unique performance fee structure. So we have all the same traditional providers, like we said. We also provide a 2 and 20 fee structure, which is very typical for a hedge fund. And then we also came up with something that, because we felt, if we thought that the market was going to go straight up, should we really get 20 points of carry? That seems extremely egregious. So instead, we created a Class B share, which is 2, 5, and 50. And so we have a 2% management fee, 5% appreciation, similar to what the 2 and 20 is. And then we share in the alpha that we create. So if you're in accumulation mode, then what do you care about? You care about you giving me those assets, us managing them well enough that we actually produce more of those assets for you, and then we share in that. And in addition to that, what we've done is, if there were to be a negative in alpha trading, then any of our other fees offset that capital loss account. So if there's appreciation in Ether, that's offset into our alpha. So essentially, Dharma has set up itself so that we're making sure that we're very in line with our investors, and really we're actually only making money if we're making alpha for our clients.
Yeah, the incentives are clearly aligned. I mean, it seems like those results you just mentioned put you in by far in one of the best performing funds during that time period, right?
Yeah, yes, and we're very happy with what our returns are. And, I would say it's methodical, right? As Andrew had mentioned, our goal to our investors is to produce 12, 15% for their accumulation, right? Increasing the number of units that they have. And then by basically being methodical there, and given that you have this very high volatility asset, it's the perfect opportunity to be able to capitalize on that. So there's a lot of really interesting situations where you have great risk reward, structures.
So you mentioned before that scaling is one of the preeminent factors to global adoption, and I would agree, especially scaling on layer 2 while the base layer is still decentralized, unlike a lot of the crypto competitors that I think are too centralized, like EOS and Tron, and take your pick here. But the point is, whether Connext or Counterfactual or any of the ETH 2.0 teams on sharding take off or don't take off, your fund is optimized to take advantage of those potential price falls. Is that the best way to think about this here?
Absolutely.
So, Andrew, let's go back into the thesis on Ethereum here. Are you sitting at the table with fund managers and institutions and having to convince them about Ethereum, or are you more having to convince them on the strategy here?
So I'm having to teach them what is Ethereum, because the majority of them don't know what it is. And once we've gotten through the facts that we're taking for granted, especially at legacy fund managers, of just basically logging into internet service providers, your FANGs et al., then we talk about and we kind of re-architect the thinking of a peer-to-peer decentralized internet. And then we really try to explain what the enterprises are doing in the space, what the governments are doing in this space, what the regulators are doing in the space, and also have to teach my poor man's analogy of intranets into internet. And my thesis is we're still in the equivalent of the early 90s, and we're starting to see the blossoming crossing of the chasm. I think last month were two very remarkable signals within public Ethereum. One was Ernst & Young, one of the largest Big Fours, producing Nightfall, which is a privacy layer, which, in addition to James talking about scalability, I think privacy and confidentiality is just as important. And that's a public Ethereum open source project that they've gifted to the world. And the other one is seeing a bulge bracket bank in SocGen issue a public bond on public Ethereum mainnet. And I mean, those are it's the first pitch of the first out of the first inning of seeing real enterprises deploying to the public Ethereum mainnet. So I think all of the interesting work and all of the progress and all of the opportunity is still in front of us.
It's incredible. So, I mean, Andrew, you clearly are, the preeminent sources on the technology and the teams in the Ethereum space. James, you clearly know the strategy and the quants and the optimization and the risk management here. Who talks to clients more here? I'm wondering at this stage.
Well, as you can tell, we're doing this interview and we sit next to each other. So I don't know, we're kind of joined at the hip, and it really is that having that experience within blockchain itself, the risk management, the trading, of the asset. That's exactly what we do at Dharma, right? We're looking at it not just when people talk about risk management. Inevitably, they think, just at price risk. And with this asset, you have a lot of different other risk considerations. And so that's where we apply that same type of risk management methodology, not just to price, but we look at it from the regulatory side of it, right? As we mentioned, the custodial side. There's a lot of different parts where to truly have a professionally managed account, you have to apply all of those different points.
Makes a lot of sense. And, we'd be remiss to not go into your guys' extensive careers at ConsenSys. I think a lot of people are coming into the space now in 2018 and 2019, and they're sitting here with these assets and DeFi and everything, being built out already. What are your feelings on Ethereum, because you're at ConsenSys, 2013, 2014, 2015 versus today? Is the energy the same? Are the teams the same? Are we moving as fast as you thought we would? Where are we today versus your views then?
We still have a lot of work to do, but we are exponentially stronger and farther ahead than we were years ago. Literally, this was built from nothing, out of thin air. It was a concept, and we had no developer tools. We didn't have an ecosystem. We didn't have an enterprise platform. We didn't have standards. And all of this is being built at the fastest pace I've ever seen any technology be built.
How do you guys feel about competition in the space? I guess we could go into hedge fund competition, but let's go back to, not to put you on the hot seat, Andrew, back to smart contract competition here. I always view it as Ethereum's race to lose. So I always look at Tezos and Polkadot and all of these competitors as, are the developers going to move there? What's your thoughts here?
So I do think that it's Ethereum's race to lose. I think Ethereum is far ahead. That being said, I think one consideration is as the virtual machines all condensed to WebAssembly. So we're seeing Polkadot, Affinity, Ethereum 2.0 all go to a WebAssembly. So basically, the smart contracts could move relatively seamlessly. And I don't know how that's going to play out. But with respect to the developers and the mind share that Ethereum has, and just the battle testing, nothing else is out yet. I mean, with respect to Tezos, that is out. But I don't see any type of movement like I do in the Ethereum ecosystem.
Do you think a lot of the community is purposefully mismarketed, or they're just being not honest with the community? I mean, Polkadot markets as a bridge, but they're running edgeware with smart contracts and hopefully building that out on Substrate to make it easy to build blockchains and applications. Do you think that everyone's just being nice, saying, hey, we're not an Ethereum killer, but in reality, that's their target?
So what I would say is that nobody that's smart enough to build protocols like Ethereum or Polkadot should be marketing. And I haven't seen a protocol yet that was capable of marketing. Ethereum Foundation doesn't do it. I don't think Polkadot does it. So I think that they should just be building the best software to run the planet most efficiently.
And one other question here, Andrew.
Yeah.
A lot of teams like EOS has $3 billion. They had $4 billion. I don't know where the other billion went. I don't think anybody does. Tezos has, I think, 5 or 600 million. The Ethereum Foundation has, I think, 0.5% of all ETH. I think it's around 150 million bucks. What's your take on, can the competitors buy an ecosystem or not?
I don't think something like EOS could. Because the fundamental architecture is centralized. You might as well run a SQL database.
Thanks a lot. Yeah, I don't know why they don't just run their apps on AWS.
Yeah, exactly.
Yeah, you're trading off throughput and low cost for 20 cartels. James, back to you. When you're thinking about the space, you guys, a lot of your strategy hinges on there being underlying volatility. Do you think that as the space matures, your strategy could drift away if we lower volatility, or what's your thoughts 5 years from now? And that would be a good problem to have.
Right. How would we look at that? So you're saying specifically then of Ether, right? Because I would say that volatility is typically a friend for quantitative trading systems, right? So we like that. But I would also say that if we're looking at 100 volatility, now we move down to 20 volatility, right? We're still trading at S&P and other types of asset vol. So what will happen? You'll have a lot more different types of structured products, more optionality into the marketplace, a lot more participants in the place, so there'll be a lot more capital. So, as we mentioned on the SocGen putting out a bond, that can be common stance, right? And you can then add on, does somebody issue something in Ether? Do they put a floor and a cap on the product? So the trading strategy, there's two parts to that. You like liquidity, you like volatility. So as that liquidity also increases, right, there's much more that we're able to transact. So I don't really worry about that side of it. And honestly, it's more of that's what trading is that you do look at what is your asset, what is going on in this space. So it's definitely not a static vehicle that we go through.
So a lot of your strategy, which I think resonates with your investors, is having something that's systematic and repeatable over time. How many of your competitors, or I know you said you don't have any, but how many crypto funds out there have an actual systematic strategy? What percent would you give?
Yeah, I don't even like to go to there because what are they doing? I don't know. Right, we're not on their desks. If they are at desks, right, you have market makers, right, that are going to be trading their assets in one way. There's others that are just they know the technology, and so that's why they got in early. So they had a an axe of a position to trade. But I really wouldn't be able to say, we don't open up the kimono to our, competitors to say, here's how we're trading.
And when you think about the landscape for what you can roll out different doles for, what are the criteria for rolling out a dole? Are there any new ones on the horizon that you plan to or are investigating here?
Yeah, so I think we might have mentioned it earlier, but we go through, let's say, our fundamental analysis, right? And as it meets our Web3 thesis. And then from there, it needs to have regulatory clarity and liquidity. So as our target audience is much more, institutional size, we need to be able to trade $25 million a day without moving the price. And if we do, then it basically becomes an investment that our institutions can't. They can't allocate enough funds for them to make it worthwhile. So it's really that's kind of our niche for the assets that we may roll out. End of July, we'll be rolling out the Dole BTC. And then there are a few different protocols that we're looking at, as Andrew had mentioned, potentially Definity and Filecoin and a few others. It really becomes, what are those core holdings that someone would want if they wanted to be invested in the blockchain space?
I know you alluded to this earlier, but how important is risk management from a fund perspective? Because I feel like a lot of funds just lever up on BTC or focus on an asset here.
It's funny. Back at Lehman, this is a million years ago. There was a CFO in Orange County who basically just levered up as much as he could Treasury bills, and Treasury bills, those are super safe, except when you're at over 100-to-1 leverage. And that became a investment strategy. I would just say that's not a strategy, right? There are traders and they can swing it around as much as they like, but we're looking at this as, we want it to be methodical. We're not excited about, we have this one superstar trader and then the other four guys, they're okay, and then this other one's going to compete. That's not what this is about. This is about consistent returns, consistency throughout the whole organization, and throughout what is our investment strategy, our risk management policies. All of those have to be much more of this is a repeatable, consistent business.
So in line with that, a lot of funds, I think, in the space go dumpster diving for outsized returns on smaller altcoins, but there's only so much capital you can actually deploy into coin number 150 here.
Right.
If you guys got 50 million inflows tomorrow, you'd be able to manage that.
Yes. And it wouldn't be in those, obviously, into those coins, right? They wouldn't make probably our fundamental side of it, and then our liquidity or our regulatory, basically characteristics or hurdles. So, that's why for us, we really are looking at it as, what are the representation of the market, and, what should a core holding look like?
Makes a lot of sense. So one of the last questions here is something people don't think about and something you're focusing on, which is treasury management. A lot of teams and funds, or a lot of teams and projects, raise a lot of money. Hedera, Definity, take your pick here, and they have no idea how to manage it. And I think we've seen that through Steam laying off employees, NEM, take your pick here. How do you guys approach that from a team perspective? Because I feel like a lot of teams will say raise an ETH, but they'll never convert it into cash. They need somebody to manage that.
Yeah, it's funny because obviously you have a lot of really intelligent people that have created these different projects, and so I bet even in their own minds they're like, well, I should be able to then do this as well, right? I know how to build this, and I should be able to manage those assets because I love this technology. And loving this technology, that's fantastic. That gets you into the space, but that isn't what investment management, that's not what risk management is about. And there's a whole expertise just within that realm. And so, we absolutely, when we speak to different groups, we basically say, fantastic. ConsenSys is a great example. ConsenSys, you build tremendous types of products, working at the protocol layer, lots of different tools, and should they be then managing their own assets? Well, they're not traders. right? So they're not they're not looking at all the different risk parameters within the space. And it's also just not their business to say, we're going to also take one of our core assets and not do it from a professional level is really dangerous. So when any of those type of organizations, it's more we work to them, and that's why we created our fee structure to say, how are we going to get paid? We're going to get paid if we produce you more alpha. And so if we're going to produce more alpha for you, and we're going to manage this in a professional manner, and here are our processes, here's what we take everything through, then that becomes, I think, a great conversation for them to understand, great, I focus on my tech. How do I build that? And then from there, we're able to partner together.
Makes a lot of sense. So after going through the entire process of Dharma, getting investment, getting, having your strategies live in the wild, and having all those conversations, and Andrew, you've had a zillion conversations around the world with governments and corporations and everybody on Ethereum and the EEA and Microsoft early on. How far do you guys think we are from seeing, one, on James's side, we'll go to after, but real institutions invest. Then on Andrew's side, the real institutions take this from pilot to deployments.
Well, so I would already say Dharma is a real institution. So that's not, I don't know if I go with that side of it.
I guess the Goldmans of the world, or
the rookie firms. I understand. So let's say that it's investors or teams that have billions under management. This would be a portion of their portfolio. It may be a very small percentage of their portfolio, right? And so that becomes, what do they do? Similar to the Treasury question that you had asked. That's not their expertise, right? So as a technology company would outsource their Treasury, when you look at those different types of multi-strat investment funds, they're also going to go to the experts that know that part of it, right? It's not typical that somebody trades, I trade munis, derivatives, equities, some FX, and everything like that, right? And so, and then when you get into this space, which is very new, and it also has its own risk parameters, it becomes, well, now you do look at this, right? So I, the way as I was referencing before, part of our thesis is global scalability. I always keep going back to that, because as we get validated more and more, and that improves or increases, that's where we get closer and closer to true adoption. And so back at, let's say 6 months ago, you had Jamie Dimon just saying, I hate blockchain, I hate Bitcoin. To erase that conversation, the way to do that is global scalability, which then leads to adoption, right? That's the trigger point, the tipping point, where I would say that the different types of pension funds can be involved in this space. The characteristics that are needed for that, one, as we said, was custodial. The other side of it within the market structure is how do we trade that, right? So we need, we'll have more and more market makers. Different Wall Street, bulge bracket firms will be market making, one for their own clients, and then they're also their book. And that's where you have a lot more liquidity that enables more institutions to be able to be involved, right? So it's baby steps. Dharma is part of that catalyst, because right now we can offer out today an institutional product that enables institutions to have exposure, to be involved in the space. And then as more and more validation of the technology occurs, now they can commit more and more resources to either building up a desk and other types of infrastructural product.
It's excellent. And Andrew, switching over to you, just on the tech side and the human-to-human process here.
Sure.
When we compare you guys to, I don't know why we would, but let's say we are, because it's different ages in the life cycle here. But you've been around the world talking to everyone from institutions to companies to governments about Ethereum, and that's a very human-to-human process where they're aware of it and they know it. How far ahead does that put Ethereum versus Tezos, Polkadot, et cetera?
So I think it puts Ethereum far ahead, but I think that it's still the first out of the first inning. There are a few things that we need in order to cross the chasm. One, I think, has been driven very well by the EEA, which are standards. I've said this now till I'm blue in this space, and I have to credit Jeremy Miller. But basically, Java became J2EE, which was the most permeated software language on Earth when there were standards, when there were clean web APIs and clean database APIs. And a developer that was in Mumbai, Paris, or San Francisco would be working off the same standards. And that's how you didn't have to recreate the wheel. And we're seeing that in the Ethereum space with identity standards, token standards, wallet standards, exchange standards. So we're not having to recreate the wheel, and people can build building blocks on top of it. Next is the scalability that we've spoken about ad nauseum today. Another piece is privacy and confidentiality. And then a lot of these institutions, their IT spend is mostly to keeping the lights on, especially in financial institutions. And we're starting to see small proofs of concepts with that 5% budget that they have to experiment. But we may see whole new types of financial institutions being built altogether that leapfrog those institutions of yesteryear. So I think we're still so early, and I don't know if it's going to come from the inside out or the outside in, but it will be interesting from both directions.
It's excellent. And to close, guys, who's the smartest person in crypto? And you can't pick each other.
Definitely Vitalik.
James?
I'll go with that one as well.
Vitalik, it's great to have you guys here with us. And for those listening, where can people learn more about Dharma? Where should they follow you guys?
Absolutely. You can go to our website, dharma.capital, so DARMA.capital. And now you also have to follow me on Twitter. So
that's your Dharma Capital on Twitter, and then your Dharma James, I think.
Exactly.
And Andrew Dharma now?
Yeah, Andrew Dharma Cap.
That's awesome. Well, guys, congrats on everything, and I'll have you on again soon.
Thank you.
Thank you much.
Hey, everyone. Thanks for listening to the podcast. If you learned anything on this episode, please retweet and share the episode and throw us a 5-star rating in the iTunes store.